All right, let's talk about something that is quietly but completely changing the game for how money is managed. We're talking about machine learning. In today's financial world, this crazy mix of crypto, global shocks, and all sorts of new products, a new kind of intelligence is stepping in to try and make sense of all the chaos. Let's get right into it.
So let's just get to the big question on everyone's mind, right? Is Wall Street secretly being run by robots? Are we just handing over our entire financial future to a bunch of algorithms? Well, the answer is a lot more interesting than a simple yes or no. So here's the game plan. We're going to look at why the market is so much more complicated today. We'll ask if machines can really predict what's going to happen. Then we'll see how AI helps pick stocks, how it builds smarter portfolios. And then, this is important, we'll get into the big risks. Finally, we'll look at the future, this partnership between humans and machines.
Okay, so first things first. Why are we even talking about this? Why do we need machine learning in finance now? Well, it's pretty simple. The old maps that investors used to use to get around, they just don't really work anymore.
Think about it. The financial world today isn't some straight highway. It's a giant, confusing maze. You've got entirely new things like crypto and DeFi that barely existed a decade ago. And, at the same time, a single event on the other side of the world can create these invisible tripwires between different assets. Honestly, just trying to navigate this with the old tools is getting harder and harder.
And this is exactly where a new tool comes into the picture. To find a path through this new maze, people are turning to a totally different way of thinking, and that's machine learning.
For forever, investing has been about traditional analysis. A human expert, a really smart person, reading through company reports or staring at stock charts, trying to make a judgment call. Machine learning? It's a whole different beast. It uses these powerful models to chew through enormous amounts of data, and it's looking for these weird, hidden patterns that a human brain, well, it would probably never, ever spot.
So what even is machine learning in this context? Let's just break it down. It's a kind of AI where instead of giving the computer a strict set of if this happens, then do that rules, you feed it a mountain of historical market data. And the machine starts to learn the incredibly complex rules of the game all by itself. It literally learns and adapts as it gets more information. Okay, so that's the theory. But how does this actually work when the rubber meets the road? Let's start with the first big job of any investor, just picking what to buy. Choosing the ingredients for your portfolio.
Traditionally, this whole process rests on two main pillars. First, you have fundamental analysis. That's all about digging into financial statements and news to figure out what a company is really worth. And then you've got technical analysis, which ignores all that and just looks for patterns in old price charts.
Now, here's what's so cool. Machine learning doesn't just toss these ideas out the window. Nope. It puts them on steroids. For that fundamental analysis, it can scan and understand the feeling behind thousands of news articles in seconds. And for technical analysis, it can find these insanely complex patterns in price data that no human would ever see. It's basically adding rocket fuel to time-tested ideas.
All right, so the machine has helped us pick our ingredients. Fantastic. Now for the really tricky part. How do you combine them into the perfect portfolio? In other words, how do you write the recipe?
The classic way to build a portfolio is something called the Markowitz model, but it has a huge flaw, and this quote absolutely nails it. See, the model assumes that the way assets relate to each other is stable. But in today's world, that's just not true. When a crisis hits, things that were supposed to be separate can suddenly all start moving down together, completely wiping out your diversification.
And this is where machine learning has a massive advantage. Because it can see these deeper, more complicated relationships, it can estimate risk and return way more accurately. It can build portfolios that are just tougher, and it finds these clever diversification tricks that a traditional model would miss entirely. The result? Hopefully, a much smoother ride.
And hey, this isn't just a theory. The numbers are pretty stunning. One study found that a portfolio built using machine learning delivered over 30% more return for the exact same amount of risk. So to put it simply, you're getting more bang for your buck. That's a huge deal.
But, and you knew there was a but coming, that kind of power doesn't come for free. When we start relying on these incredibly complex new tools, is there a chance we're kind of flying blind?
This really gets to the heart of the problem. Okay, the machine might be spitting out the right answer, but if we have no idea how it got that answer, can we really trust it, especially when we're talking about billions of dollars on the line?
This is what everyone in the field calls the black box problem.
The models can get so complex that even the people who design them can't fully trace back the logic for one specific decision. It's like you put the data in, a brilliant answer comes out, but what happened inside the box is a complete mystery.
And that black box leads to an even more terrifying thought. As more and more investment firms start using the same kinds of AI models, what happens if they all make the exact same mistake at the exact same time? You could be looking at a system-wide meltdown.
So these challenges are absolutely real. You've got the black box and systemic risk, which we just talked about. But then there's the age-old data problem. Garbage in, garbage out. If your model has never seen data from a real crisis, it might totally freak out when one actually happens. And sometimes these things can be too smart, finding patterns that aren't really there and making dumb moves, like picking a stock just because it doesn't trade much and its data looks clean.
So you've got this huge potential on one side, and these really serious risks on the other. Where does that leave us? What does the future actually look like? Well, it's not a battle. It's not human versus machine. It's a partnership.
Pretty much everyone agrees we're not heading for a future where robots completely take over investing. The real goal is to augment human intelligence. The absolute best way to think about it is this. Machine learning isn't the pilot. It's the most powerful, data-crunching co-pilot you could ever imagine.
And that combination is where the magic happens. You let the machine do what it's amazing at, just tirelessly scanning insane amounts of data, finding patterns, and running the numbers, and you let the human do what humans are best at, providing oversight, asking skeptical questions, using intuition, and making that final judgment call.
So, the real path forward probably isn't building the most complicated black box AI you can imagine. Instead, it's about creating simpler, more understandable machine learning models that act as powerful tools to support, not replace, the wisdom and experience of a human manager.
Which really leaves us with one last question to chew on. As all this technology gets better and better, the real debate isn't about whether the best investor of the future will be a human or a machine. It's about how we can best combine the two to create something way more powerful than either could ever be on its own. Thanks for tuning in.